Hello, welcome to Blocksiders. My name is Luke, and today we're going to be talking about the Goldman Sachs client call that went out on the 27th of May. This is important to the crypto community because it's one of the many calls where Bitcoin is actually being included in a large degree. The information included in the report is actually quite interesting, so I'm going to go over that fairly quickly today. I'm going to try to keep this reasonably short compared to the other releases that I've done. But first, before we get kicked in, I just want to talk about the division that released this report. It's the Consumer and Investment Management Division. So if you have a look at their website, and I've actually got a screenshot of it here, it's very calming, very chilled out, nothing overly exciting. And it includes a number of different divisions. So it has Goldman Sachs Asset Management, Wealth Management, and then other consumer businesses. So the target audience for this report are sort of mum and dad investors, people with their 401k, or in the case of in Australia, it would be superannuation. But it's basically people who are a bit more on the conservative side of investing, who would usually be looking at things like, as you can see here, private equity, commodities, hedge funds, real estate, fixed income, this kind of stuff. So the kind of people working here would be like financial planners, base-end stockbrokers, or not base-end stockbrokers, but that would be like stockbrokers, looking at solutions that are going to provide something above alpha. However, these aren't necessarily your real high risk, traders or anything like that. They wouldn't be advising, for example, this wouldn't be their prop trading department or something like that. This would be targeted more towards consumers. So the report itself is going to be mildly conservative. Hence, what I believe anyway is their reason for what they've said later on in regards to Bitcoin and other cryptocurrencies. So we'll get kicked in. This is obviously the name of the title, US Economic Outlook and Implications of Current Policies for Inflation, Gold and Bitcoin, written on the 27th of May. So this is basically what it's talking about. Now, I've cut out a lot of the COVID stuff because we all know what's happening with that. You can look at the news every day. So we'll just jump straight into slide number 7, where they're basically looking at the growth rate of the state. So as you can see here, particularly on this one, mortgage applications, as well as total credit card spending, we can see that this has dipped off significantly in March. However, the negative growth is decreasing, or increasing depending which way you look at it. But the negative growth, essentially, it's looking more positive, is what they're saying. Although it's still negative, although spending is still down, and that mortgage applications are still down from the norm, we are seeing a rise to see these things increase over time. So they're basically saying that things aren't going to be too bad. Something they do say in the next slide, which is about GDP, is that they believe that GDP is going to be down about 6.3% in 2020, but looking like it's going to be back to where it was last year, rising by 6.1% by 2021. So we'd be at a GDP similar to 2019 by then. So down 6.3, back up 6.1 from that. So they're basically saying that, this is going to be, an in and out kind of thing. It's going to basically go down, come back up. 2021, everything's going to be back to normal. However, in this slide, they're saying that there's different views held by different banks or different research organizations. And I would note here that the Goldman Sachs research is actually the most bullish on third quarter 20, looking at an on-quarter increase of 29%. So these guys are a bit more positive than the others. The first point we'll go over is jobless rates. So this is where they talk about the amount of jobs that have been lost over the past little while due to the current pandemic. As you can see, job losses are continuing. However, the most amount of job losses occurred late March, early April. However, the rate at which jobs are being lost is decreasing over time. So as you can see down here, as of mid-May, there's only 2,500. Actually, that's 2.4 million, whereas we're looking at 7 million a week in in late March, early April, which is fairly significant. Now, I mean, these are massive numbers when you have a look at the overall population of the United States. I mean, these are huge. But then we go down and we see that this is pretty much where we're at. This is the adjusted unemployment rate. This is where they put it on the graph here. So compared to where we normally sit, which is this band that goes up and down, obviously around 2010, that was the GFC, pretty high. But now it's just shot straight up. And at the rate at which people still losing their jobs, I mean, that rate is going to continue. The longer that we see lockdowns, I'd probably say arguably that the most recent drama they've been experiencing in the States hasn't helped to sort of quell this, or at least reduce it, considering the damage done to businesses and obviously general consumer sentiment hasn't been ideal. They later go on to talk, and I'm just going to preempt this in the talk. They have a look at the previous depression and what that looked like. So if you're going to have a look at unemployment over a number of years, the United States sort of whips between, upwards of 12%. But over the last sort of 50 odd years, we've been sort of tracking between 10 to 4%. Nothing too crazy. This is the Great Depression here. This actually came off Wikipedia. This is the Great Depression, where we see unemployment rates approaching 22%, which we've already crossed. So that's a fairly significant sign of what we're sort of seeing coming out of the United States at the moment. One of the things that Goldman is a bit positive about is that they believe that a lot of these job losses are temporary. So we're looking here to say that the vast majority of jobs lost in March and the most in April are temporary, not permanent. This is an example of people who are, say, from cafes, restaurants, bars, things that have been forcibly closed due to the lockdowns that we're all probably experiencing at the moment. So they believe that these will come back. I've probably got a different view that a lot of these businesses, probably not all, but a lot of them probably won't come back. Mostly because anyone who's run a business will be able to tell you it's not just an overnight thing where you switch it off and then you switch it back on again 6 months later and everything's okay. A lot of these businesses, despite handouts or even with handouts, will probably fail. And they won't be able to hire those staff again. And if they do come back and they're okay, they probably won't be able to hire as many staff back, because as the United States probably slips into a recession, people will be spending less, saving more, which means they're not going to be going to bars, retail outlets, restaurants, things like that in order to spend. So I think that I think that blue should be a lot more red, because I think a lot of these job losses are going to be permanent. And during a recession, generally people don't hire as much. So that's also going to be a bit of a concern, which we'll also have a look at a bit later. This is where they're saying that they're comparing the previous depression to what we're seeing now. The most arguably the thing that we can see here is that the S&P 500 has gone down 86% over a period of 32 months, which we haven't yet seen. However, it's still early days, so who knows? We'll see what happens there. So this is the amount of money that the United States has been printing in order to sustain their economy. We can see here that in 1943, they actually, as a percentage of GDP, they actually spent a lot more. However, the United States government is spending less. They're spending the vast majority of this obviously in 2020, and then they're looking at spending a little bit more in 2021 to sort of drip it out over time, so they're not spending too much in one go to try to sustain the economy. However, if we're going to be comparing, the 1930s to now, it's not looking overly fantastic. Here we have a look at the amount of US debt that they have. Now, this is obviously a record. They didn't have this problem during the Great Depression. So, this is yet again another issue. And this obviously affects not only inflation, but it also means that the government has less and less confidence in printing more money moving forward. So, now we're looking at things like zero interest rates, negative potential interest rates, which obviously has a massive effect on people who are obviously have money in the bank. So one of the big things that we talk about is inflation, which we can see here, and they're sort of saying that we haven't seen any crazy increases in inflation due to this. However, it's still early days, so I'd probably say that's a bit of a concern. The other thing as well is what the Fed is spending this money on. So a lot of the money that the Fed is printing is going into bonds, as well as covert, or not really covertly, because everybody knows about it, through bonds, through US Treasury, or that's US Treasuries, mortgage-backed securities, as well as into the stock market itself. So a lot of money is being pumped into that to keep that alive. But how long that's sustainable, we'll just have to wait and see. So this is where they talk about monetary theory and negative interest rates. Now, the biggest concern is that as interest rates decrease, people may end up wanting to save more. So the idea is that if I'm earning 0% interest on my savings, I was expecting to earn 2%. I had $100,000 in the bank, and I thought that at the end of the year I'd have $102,000 because I'm saving for something, whatever. So if interest rates end up being zero or negative, it means that people may end up needing to save more, or they're going to move that money out of cash and put it into something that might actually earn a return. But if you want a really safe, as the saying goes, cash is king, especially in a recession. So this could actually see a negative effect to the economy, where people aren't going to borrow more at a negative rate, or it'll be flat by the time it gets to a human being, or a very, very low 1%. People might not borrow because the consumer confidence isn't there. They may end up just keeping more money in the bank and saving, which then means that there's less money in the economy and less spending going on. Bigger problems for jobs, bigger problems for businesses. Here we see where we're looking at the relative value of the Australian dollar, the US dollar. And this is obviously a concern because we're seeing that the value of the US dollar sort of has remained flat. However, the issue being that it's only flat because the world is experiencing this current pandemic. So every world currency, every basic global economy, or every big economy is doing the same thing, printing money, putting out stimulus, and then devaluing their currency. So if everyone's doing it, it means all currencies are devalued, which is why we're seeing such a run in things like gold, something that's seen as being a bit more of a stable asset, especially to hedge against both currency devaluation and inflation. The one interesting thing that they talk about in this area is they say that the S&P 500 is a better hedge than gold. I've got a few different views about that, but the most misleading graph that they've put in this entire thing is this one here, where they say that gold returned since the 5th of April 2020. So this is right in the middle of after everything crashed. The S&P bounced back 20%. Gold only went up 5.5%. What they don't mention is that the S&P crashed by about 30%. Leading up to this, whereas gold sort of remained relatively stable and kept going up. So it's a bit of an unfair marker. However, I've included some charts just in a little bit below. They're basically saying that gold, valued against today's dollars, this is the average value, and we can see that basically they're saying that gold, isn't an ideal hedge against long-term inflation. You should be investing in stocks. This is what this graph sort of is saying here, that gold is the yellow one here, and this is generally how it outperforms inflation by about, generally between 50 to 60, 70 odd percent, whereas US equity generally has outperformed by 60 odd percent, 70 odd percent, all the way up to 100. So it generally outpaces inflation. The biggest issue, though, is that obviously a lot of these US companies, especially at the moment, it might be okay for the long term, but in the short term, they're probably going to be experiencing a fair amount of stress. So this is a fairly unique situation. So this is a chart that I think is a bit more fair to have a look at. And this is basically performance of the S&P 500 versus gold since the start of 2020, since January 1. And as you can see here, the S&P's gone down by about 1.72%. So you'd be down if you bought a bunch of the S&P at that period, or you bought the indice at the index rather at the start of the year. Whereas in gold, you would have made 10%. So the previous chart that I talked about is fairly misleading. This chart here I actually put over a significantly longer time period. So this is since 1998. So this includes the GFC and then obviously what we're seeing now. If you would have bought gold in 1998, so we're talking over 20 years ago, you would be looking at a return of 56%, fairly significant. 58%, sorry, the text is a bit low on my screen here, 458% return. So that's pretty good over 20 odd years. The S&P 500 would have only returned you 244%. And the outperformance of gold as a percentage has been pretty much better since 2006. So if you would have bought gold, because obviously if you would have had gold during the GFC, now the only thing this doesn't take into effect is dividends. If you owned shares that were paying dividends, you wouldn't have obviously received those if you had gold. So a little bit of a grain of salt with that, but it's still fairly significant, especially as an outperformance. This is a chart with Bitcoin put over the top. This is from the 1st of January, and as you can see for the year so far, Bitcoin has outperformed Bitcoin is up 40%. And then as we know, gold is at about 9.5%, and the S&P is down 1.76%. So pretty good. And I've always said that, Bitcoin rather is moving to be a hybrid of, a hybrid of gold, basically, just significantly more volatile. So it's not for the faint-hearted, but we are moving into that space where Bitcoin could be considered a far more accessible basically store of value than something like gold, because it's a bit more of a nightmare to get your hands on physical gold than it is to get your hands on Bitcoin. It's quite easy to get Bitcoin, especially, you know, there's an exchange in every country converting local currency into Bitcoin, so it's not that hard to get a hold of. Yet again, I don't know where they've pulled this from, but they're basically saying that gold, the correlation between gold and inflation is not ideal. However, I'd say that over a longer period of time, you know, it generally outperforms equities anyway. So it doesn't offer downside protection. I don't know where they're getting that from. Now, the big thing we need to look at, especially when we start looking at inflation, is how it affects everyday people. So how does it affect you as a human being? This is something called the Big Mac index versus inflation. Now, the chart, the most up-to-date chart I could find was up till 2016. And you can see here that over a period of time when inflation was sort of, you know, pretty stagnant, the amount of money you would pay for a Big Mac over time has actually outpaced inflation, meaning that a business like McDonald's that feeds over 1% of the population globally every year, 1% of the population every day, they feed 1% of the population every day. That's how much food is produced. Their costs, their staff costs, their costs of obviously producing a Big Mac have gone up enough that the price has actually been pushed up significantly higher than inflation over the past 20 odd years or even longer. However, the most recent acceleration you might want to see was obviously, you know, we had there was a minor recession in the early 2000s after the dot-com boom, and there was a few other bits and pieces going on. We saw that line sharpen, and then after the GFC, we saw that line sharpen up. So it'll be interesting to see what happens here. So basically what they do is they look at, you know, how much inflation actually affects real people. So I'm not saying that everyone eats McDonald's. I'm not saying it affects everyone in the same rate. However, this is a good example to see the ways in which these monetary policies. Remember, QE came in around here. After QE, obviously the price of the Big Mac went up significantly. So this is something that this money printing has an effect on that literally affects everybody. It's actually quite interesting to have a look at this. And they actually use the Big Mac index to work out the true value of a dollar between countries. So here we then have a look at, and this is when I sort of scoff at what they say about gold and inflation. This is the price of a Big Mac over the same time period. It finishes in 2014. How much you can buy with, I think it's 100 grams of gold, milligrams of gold. How, you know, what 100 milligrams, you know, what the price of a Big Mac is versus 100 milligrams of gold. As you can see, it's actually gone up and down. It's a bit all over the place, but over time, because of the increased value of gold, you can see that pretty much you can buy, if you had 100 milligrams of gold in 1986, you can pretty much buy a Big Mac today. I would argue that gold is an incredibly good hedge against inflation. I'm not necessarily advising people go out and buy gold, but you know, I wouldn't necessarily, everyone listens to everything that's said in these reports either. Then we get into the more juicy part, which is the Bitcoin part. Now, this is where they talk about, is it a currency or an asset class? Now, just remember, as I said at the start, you have to understand the division that's writing this report. And they're approaching it from the way that they would approach any kind of like any asset. It's not used as a medium of exchange. I actually think that's a fair comment. We aren't seeing Bitcoin used as a widespread medium of exchange, or most other cryptocurrencies. I mean, I know that we are seeing solutions that involve cryptocurrencies that are used a bit more widely. However, even something like Ripple is not used on a day-to-day basis by, you know, everyday human beings. So, I mean, I guess that is a fair call at this stage. However, it doesn't mean that it's always going to be the case. They serve as a unit account. These are three criteria of sovereign currencies. They serve as a unit account. Now, the only thing Bitcoin serves as a unit of account of is other cryptocurrencies, especially coins that don't have a USD pair or something. So this is, I mean, this would be true of Bitcoin, that it does actually serve as a unit of account. However, on a global scale, as in compared to a global market, I mean, people aren't valuing gold or oil against Bitcoin. So I'll own that from the perspective of a consumer-facing like investment group. I'll take that, or a store of value. Now, I have argued before that the gold is moving more towards that. However, it's still immature, and it's still obviously, you know, widely uninvested in market. So when we take that into account, I mean, these are all valid points. from the perspective of a consumer-facing, like financial advisor point of view. So I'll accept those. However, I do not think that this will always be the case against it. All these statements are actually true. Bitcoin and other cryptocurrencies do not generate cash flow, not at the moment anyway. I know that you can stake, you can mine, however, the amount generated at a global scale is not really high enough to warrant it being classed as an asset at this point. However, if you have a look at the growth in the industry, you might be able to see that this could be the case down the line, especially DAOs and DeFi and things like that. This could actually refute that over time. Do not provide consistent diversification benefits given their unstable correlation. This is also true because remember, over the GFC, Bitcoin, or over even the current pandemic, Bitcoin fell and rose more than, say, the S&P and Dow and gold. It actually fell faster, recovered faster, and then outperformed. So if you have a look, I did a presentation at the start of the pandemic, sort of talking about how I saw Bitcoin rolling out, and I mean, yeah, pretty much it is far more volatile. It's a younger, far more immature market, and of course it's going to be more volatile. So I completely appreciate what they're saying here. And they do not show evidence of hedging inflation. So I'd also say that, I mean, Bitcoin has steadily rose. So I mean, that is over since it first started trading in 2009. So I'd say that probably isn't overly true because it's outperformed inflation if you have a look at it at a scale. However, I mean, yeah, there is no evidence that it hedges inflation because the market is so volatile. So any increase or decrease in inflation, which is usually quite muted compared to the price of Bitcoin, there would be no correlation. So I appreciate that, but I'd also say that sort of goes hand in hand with the immaturity of the market. Then they'll talk about, obviously, the crazy run that we had in 2017, and then the crazy fall we had in 2018 and 19. So this is more than appreciated. And this is yet again a warning more for immature or maybe uninformed investors, so they're not getting involved in something they do not yet completely understand. I would argue that probably the guys writing this probably have a fairly good grasp of what Bitcoin is, what cryptocurrencies are, and how they work. I mean, they're not idiots. However, I mean, if you're advising your customers and you're advising the kind of customers that they would, I would probably be bringing up these points too. If I was employed at a bank or a financial service institution, and one of my customers said, "Hey, I'm going to go buy some Bitcoin. Can you help me out?" I'd be like, "Dude, no way," because from a legal and an advisory standpoint, you have no leg to stand on if your customer loses money on something like Bitcoin, especially if you could be seen to be recommending it to them. Yet again, these are all fairly overdone criticisms of the crypto space. I would argue that in absolute values, more illicit activity is done using the US dollar than there is in Bitcoin, but as a percentage of overall market cap, unfortunately, Bitcoin would win when it goes as a percentage of illicit activity. However, that has been decreasing over a number of years. Yet again, totally valid point. The cryptocurrency infrastructure is still young and susceptible to hacking. We're still seeing this even today. And it's fairly significant hacks. I mean, there's usually attacks of over 10 million, sometimes more, so it can be pretty heavy. Yet again, if I was going to be recommending consumer investors to get in, I'd be saying the same thing. The cryptocurrency mania has dwarfed historical manias. The one thing I would argue about this would be that the one unique part about Bitcoin and other cryptocurrencies is that they are available globally. It's very difficult for a lot of people to get their hands on, say, the NASDAQ index if they're, depending on what country they're from. I'd probably argue that getting involved in tulips back in the day would have been incredibly niche, especially the way that market works. No internet, no phone, no nothing. It's all being done by probably print or messenger boys back then. So it's hard to, I mean, I understand, that between 1634 and 1637 that there was a bit of a rush, but I would argue that was a fairly niche market for a fairly small number of people relative to what, say, Bitcoin is, which has the ability to reach pretty much every human being that has a smartphone and an internet connection. So I would argue that maybe the Bitcoin jump and fall was more part of the fact that it was available easily and it was available globally, as opposed to a lot of these other things. Like even getting the NASDAQ, you need a specialized account that can actually buy, the NASDAQ index that not a lot of brokers have, and not a lot of, and isn't necessarily easily available in a lot of countries. So here are the key takeaways. I'm not going to run through them just for the point of time, but I will just say that this was an interesting report to read, and I don't think it's necessarily a negative for the industry to sort of have this mirror shone up against it to say, well, if you're going to be playing with the big boys, you need to address these questions. So that's fair enough. However, I would also in the same breath say that the industry shouldn't be annoyed by it, because most people who know how to buy cryptocurrency and most people who are investing in this space aren't the target audience for this report. So, but it is good that it is getting recognition at a scale. I mean, 5 or 6 slides on one of these reports is fairly interesting. It means that people are calling up Goldman Sachs and saying, I'm interested in this. And obviously their advice is that, you know, they shouldn't be getting involved, but it does show that their people are getting interested. So it is exciting times. So thank you for spending this time with me. I hope it hasn't been too long, but if you like it, please, if you liked what I've done here, please like and subscribe. And look, I look forward to seeing you on the next one. Thank you so much.